Good afternoon, and thank you for joining us for Libro's From Estate Planning to Estate Doing webinar this afternoon. We do still have a number of attendees logging in. I can actually see that number climbing as I speak. So appreciate, we just might wait another 10-15 seconds or so to give those people an opportunity to get in. We will let you know this call is being recorded today. So if you were planning to take notes or our guest speaker says something really interesting or exciting and you don't get all those notes down, please don't worry. We'll make sure that you have an opportunity to get that replay link and that would be available to you. My name is Paul McQueen. I'm the Vice President of Wealth for Libro Credit Union. I have the privilege of working with our wealth management team across the credit union, including our investment specialists and financial advisors, financial planners, and work very closely with our partners that through Credential and Aviso that help us offer our financial planning and investment services. So again, thank you. Very excited to be bringing this From Estate Planning to Estate Doing presentation to you today. And given the number of attendees that registered, it's clearly a very timely and relevant conversation. Feel free to use the chat function that's available to you on our Teams Live feature. And feel free to add any questions or comments during the presentation. We may not address or publish every question or comment, but we'll certainly look for some themes or common questions. You can choose to post anonymously if you wish to maintain privacy with your questions. That being said, we would suggest that if you have a very specific question for your personal situation, that may be better served in a one-on-one conversation with one of our Libro coaches after the event. We did receive well over 100 questions when you submitted your registrations. So we're certainly going to get to some of the most common ones of that later on in the presentation. First, I wanted to just give you a little bit of information to Libro. Not everyone on our webinar this afternoon is a Libro owner. Some of you are future owners, we hope. Just a bit of history on Libro real briefly, that we do have now 34 locations across southwestern Ontario, serving over 107,000 owners. We refer to our members at our credit union as owners. Our owners and shareholders are one and the same. We're very proud of that cooperative model. We have over 700 employees who live, work, and play in southwestern Ontario and serve our owners every day. Libro is proud to be a B Corporation certified, or B Corp for short, recognizing that we are a purpose-based business model, and we do believe in being a business force for good as we go forward. And all of that supports our why statement at Libro, that we do want to grow prosperity in southwestern Ontario. We want you to grow your prosperity. However, our wealth management team feels that requires a higher purpose as well. It's not enough to grow prosperity in southwestern Ontario. We do have to make efforts to help protect that prosperity as well. And estate planning that we're going to talk about today is certainly one way that we can do that. We're very excited to have our guest speaker here today, Doug Carroll. Doug Carroll is a tax and estate specialist with Aviso Wealth. Aviso is a national integrated financial services company that serves the wealth management needs of pretty much all of Canada's credit unions, including Libro. Aviso would be the parent company, for example, of our investment dealers, Credential Asset Management, and Credential Securities that some of you may have accounts with, as well as a range of other independent financial organizations. Doug's held many different roles in the life insurance and investment industry at both the supplier and distributor level. That is also combined with some real life hands-on experience running an estate planning law practice So he's certainly able to offer practical insights into personal wealth matters. Doug's a pretty popular guy and has contributes to and has been quoted in the financial industry media, including things like the Globe and Mail, National Post, BNN, CTV, Investment Executive, and a list that goes on quite substantially. Doug holds a bachelor's degree in business administration, a Juris Doctor or JD, which would be equivalent to the LLB or law degree some of you may be familiar with, and a master's of law with a specialization in taxation. He is a trust and estate practitioner and a certified financial planner professional, and previously sat on the board of the directors of the Financial Planning Standards Council, now FP Canada, that oversees the body for CFP professionals here in Canada. Professional qualifications aside, Doug gets the greatest satisfaction when people say he actually speaks English when he speaks law. With that, because you don't have 9 lives to figure it out, I'm going to turn it over to Doug.
Okay, great. Thanks, Paul. I lost count of how many times you said how exciting it was to talk about estate planning here, and I think that's great that that it's characterized in that way, because quite often when people hear about estate planning, it has such a negative connotation because of the morbid aspect of it. And I think that it's important that people recognize that estate planning is something which is core to what we do on a day-to-day basis. And I'll get into this specifically about the people around you, because that's what it's really about. It's about you taking care of yourself and about taking care of the people around you now and on into the future. And that's a phrase that I've used for quite a long time. I'm going to give you a little bit more background on me before launching into the content here. And specifically about my law practice activity. I'm no longer in private practice as a lawyer, but it is the core of what I had done in my early days. I set myself up in law practice after spending a few years working for a firm, and the focus of the practice was on estate planning. And I went to see people in their homes to do to have conversations and to see people in their businesses as well. So, combination of ways that I got in touch with people, with estate planning being the main activity, but of course then estate administration and other kinds of general practice I was doing at that time. So this topic is something which is near and dear to the core of what it is that I came from in terms of my professional background. And in terms of presenting on as a topic, this is the kind of thing that I've done for years and years in the roles that I've had, as Paul outlined, being a resource for financial advisors and for their clientele for the kinds of needs that you have on a real personal basis. So that's just a little bit more background on me, but I don't want to waste a ton of time here because we do have a lot of questions, as Paul mentioned, and I'm going to go through this. There's not a lot of text on these slides that I'm going to have up here. They're going to give you an outline of the estate planning process. And a lot of it is you don't know what you don't know type of thing, to make sure that you do understand that though your estate planning does need to be catered to you, and it will vary from one person to another, the core of it is quite consistent. So I'm going to take you through these slides, about a half dozen slides, and then we'll move on to the questions that we have here. This listing here of the agenda are the names of the slides that are coming up, starting with the people that are around you, which is what estate planning is about, over to the process that we go through, the documentation or papers that come out of that process, which quite often that's what people think about is, I got a will, so I've got an estate plan. But those are not the only issues that you deal with estate planning. Then turning to cost savings, if there are then any to be had, and finally to get it all going. So that's our outline. Let me start with that first topic then, looking at that people perspective. And coming back to practicality about what you are doing when you're engaging in estate planning. What you're trying to do is get certainty about taking care of your affairs. So you are part of your estate planning, and taking care of the people around you as well. So for years and years, the way that I phrase it is, estate planning, it's not about the stuff. The stuff certainly is the completion of the transfer of property that you might have accumulated over the course of your life. But the estate planning itself is about the people. So it's about taking care of you, yourself, right now, and it's about taking care of the people around you now and in the future for yourself, as well as the people around you when you are no longer around. So it's got a long period of time that's associated with it. In terms of who the professionals are that you deal with, most commonly, as you would expect, it would be a lawyer who would be at the center of the estate planning conversations that you would have. In fact, if you go back a century or so ago, ask the average person on the street who would be the estate planners, and almost invariably the answer would be lawyer as the first one, and perhaps the only type of professional that would be brought up. But at around that time in the early 1900s, we then had the introduction of the Income Tax Act. And from that point forward, then personal tax became much more of a consideration of people's estate planning. So whereas the lawyers would make sure there was certainty as to the transfer of property to the appropriate people with the right strings attached, now we had to be concerned about tax to possibly depleting our property and having that happen over the course of our lives, as well as the potential that it would happen at the point of our deaths. So tax professionals from that point forward had a contribution into the conversation, and then beyond that, you roll through the decades, we have much more industrialization of our economy, people coming into work in places where there would be pension plans eventually coming about. We have the RSP being introduced back in the 1950s. Insurance, personal insurance becomes much more common. And so the financial advisors that you have advising both on the investments and insurance you have are going to, again, have a role to play, because some of the biggest decisions that you'll make about your estate planning, dollars wise, are who are going to be the beneficiaries of those plans, your pension plan, your RSP, your RIF, your insurance plans. So those people are going to be bringing up these issues with you to look at the decisions you want to make about them. And you have to make sure that the intentions you have are coordinated. So it comes back to lawyer as the main legal or the main professional involved in estate planning, but coordinated with the other professionals who have a hand and can advise you on their component of the planning. It could be in some cases that a decision pulls in one direction, might be really good from a tax perspective, but not appropriate because you have a concern about disabilities perhaps of someone in the family, and it might be structured in a little different way where you make a bit of a concession on the tax in order to set things up with a little bit more control, or some other types of considerations where there are trade-offs. So your professionals, you want them to be pulling in the same direction. And then the last item here about people is about the beneficiaries. Again, it's about you taking care of yourself now and the future, and the people around you now and the future, and when you're no longer around. And in terms of who those beneficiaries are, they're the people that you are taking care of. And one of the things to bear in mind when you're talking about your estate planning is that a will on its own is not an estate plan, if you can call something that. A will is something which is the core of your estate planning, but it is not the only thing. And sometimes the decisions you make about who you want to take care of and how you want to take care of them may involve not including them in the will, and perhaps setting up other ways that you're going to take care of them. So those are the kind of conversations you'll have with a lawyer to make sure that the appropriate things are in the will, that maybe there are things that are kept out of the will, consciously kept out of the will, and that you do the things like the beneficiary designations in coordination with the will. So with that, I want to turn over to talk about the process that you go through in estate planning. And I use this sub phrase, the method is the message, sort of like, what's the fellow's name? Marshall McLuhan, who talked about the medium is the message, that the discussions that you have about estate planning are going to allow you to think through who you are, where you're at, who are the important people around you, in order to put the plan, and I'll put quotes around plan, to put the plan in place. Sometimes people will say, I have an estate plan, or where do I get an estate plan, as if it's something like a box that you pull off the shelf and it's got dust that you blow off and fill in the blanks, and that is an estate plan. But really, it's not that there is one particular place you're going to that you'll create an estate plan. You are going through the estate planning process, looking at yourself, understanding where you are right now and where you want to get to for yourself, as well as for the people who are around you. So though it does involve producing documents to make sure that you can fulfill on your intentions, it is about consultation with the appropriate professionals, again, with the lawyer at the center of that, but also with all of your professionals knowing of one another so that they can coordinate what they're doing and pull everything in the same direction. In terms of you and the professionals, but particularly with the lawyer, I use this phrase, expert meet expert, sometimes to say you are engaging professionals to provide you with expert guidance. And in order for them to do that, you need to disclose about yourself the things that you are being asked, the documents, the information, so they can apply their expertise. So that particular person, that lawyer, is an expert in the law. You are an expert in yourself. And between the two of you, you're able then to take the expertise out there in the world of the lawyer and apply it to you and your needs, so the two can work together, and you have a plan that then comes together that is able to draw from both the expertise and the needs that you have personally. So the starting point that I say that you have for this is the balance sheet. And that may seem kind of odd, having just said that estate planning isn't about the stuff, it's about the people around you. For me then to turn back and say, well, the balance sheet is where you're going to begin. But when you are doing your estate planning, you have intentions of how you're going to spend your life, how you're going to take care of yourself, where you're going to go, where you're going to spend your time, who you're going to help out, and how you're going to help them out. If you don't have a clear picture of where your financial life is at, then you might be putting in place a plan which is just a fairy tale. So you have to make sure that you understand, where are you right now? Where do your finances stand? And particularly, what's the value of what you have on an after-tax basis, because that's how you spend your after-tax money, so that you can have a picture of how you're going to fund out your future years and fund the people who are around you that you want to take care of. So I bring this up not because I work with financial institutions, but because that's the practicality of it. It's nice to have a plan which has all sorts of bows on it and is brightly colored. But if there's no practical aspect to it, then it's not going to come about. So that's something where your financial advisor can help you, is to get that grounding of where are you right now, where you're trying to get to, and then together with your lawyer, make sure that the intentions you have to take care of the people around you can actually be realized upon. So with that, I'm going to turn to the papers that are involved in estate planning, and specifically the key documents that are involved with estate planning, the three core documents. We'll just move on to the next slide. The three core documents that we have, which are the powers of attorney, the two powers of attorney, and the will. I then have a third item here, trust, that I will talk about, but the core documents are those first three. Most people would recognize a will and would have a concept of what's involved with a will. The powers of attorney are not as commonly known, but I think that they definitely have come into more of general knowledge in the last 20 or 30 years, particularly since the most recent Ontario law was changed back in the early 1990s. So the powers of attorney, I'll start with those. Powers of attorney exist so that you can name someone to make decisions for you when you're not able to make those decisions, or you're not around to make those decisions, perhaps. So powers of attorney as a subset of the law is principal and agent law. So you as the principal are naming someone else as your agent who can make decisions on behalf of you. And it goes back hundreds of years, the law of powers of attorney, but it has been codified into legislation at the provincial level. In Ontario, the prime legislation is the Substitute Decisions Act. So what happens with the power of attorney is You can name someone to make decisions about your property. That's the original under the common law, the judge-made law. Your ability to name someone who can make decisions about your property in order to take care of you. But it definitely was about the property. That did not exist under the common law, or that was the only one that existed under the common law, except that you could not have a person named as an attorney to make decisions about you personally under the common law. So under the Ontario legislation, the Substitute Decisions Act, we also have the ability to name someone who can make personal care decisions for us. So whereas the property is about the stuff, the personal care decision making is about the person directly. So the decisions that we made under personal care would be things like health care decision making generally and medical decision making specifically. So consent to treatment would fall under that. As well, where you're going to live, housing, how you're going to spend your time, your social arrangements, things like nutrition, making sure that you're taken care of in that manner, and how your social arrangements are managed. So all the things about you. We have the power of attorney for each of those purposes, property and personal care. You can name someone for one purpose and someone for another purpose, for one for the property and one for the power of attorney, or you can have one person who is going to serve in both respects. And commonly between spouses, quite often, the spouses will name one another back and forth and then have alternates that would follow in behind. So the powers of attorney are to make sure that someone is there to make decisions on your behalf while you are alive. Once you pass away, the powers of attorney are no longer effective, and that's when the will comes into place. So a will is basically you stating who is going to receive the property that you own at the point of your death, and you also get to say who is going to carry out that responsibility, and that person who carries that out is your executor, as in the person who executes the instructions in the will. Those of you who would know it a little bit deeper would know that the formal term right now in Ontario is not executor, it's actually an estate trustee. So the person you name does execute, in the generic terms, does execute the instructions in the will, but the role that that person actually plays is, as a trustee, that person becomes the new legal owner of your property after you die, being empowered and having the responsibility to manage that property in the best interests of the people who are the beneficiaries of your estate. So to draw in, identify the property that you have, take it under their control, protect it, take care of the administration that's involved, like reporting the taxes and paying any creditors that you owe, and then distributing the property to the beneficiaries as dictated in your will. So those are your three documents, three common documents. And the last item that I'm showing here is a trust, or one or more trusts. So as I said, the person who is your executor is the technical term estate trustee. So what a trust is, it's an arrangement where you are the original owner of property, and what you're doing is you are breaking apart legal ownership on one side, so I represent it as a triangle, and then beneficial ownership on the other side. So you're naming a new legal owner, and that's your trustee. In this case, out of your will, it's an estate trustee. You can also create trust during your lifetime, in which case the person is merely, if you want to shorten the phrase, the trustee, and that person then owns the property and holds that for the benefit of the beneficiary. So that's why I have this triangular view of things. The original owner, the new legal owner, and then the new beneficial owner. There are plenty of reasons why you might set up a trust if you have concerns about family members who perhaps are minors or will be minors, perhaps grandchildren, and you might want to provide for them out of your will. They can't legally hold property, and so someone will have to be a trustee to receive that property on their behalf. You could have situations where you've got a disability issue in the family, and for practical reasons, you may not want that person to be burdened with having to make decisions, or they may not be able to handle making decisions about the property, and so you might make someone a trustee for that person's benefit. And beyond that, particularly with disabilities, if that person as the beneficiary was to come into direct full ownership of their entitlement in the estate, then they may lose out on disability income that comes from government support programs. So again, a trust can serve the purpose of preserving those kinds of entitlements that someone may have as a disabled person. So there are a variety of reasons why trusts might be set up, but the key characteristic is putting someone in the legal authority position to manage the property for the benefit of the individual who is the beneficiary. And there can be more than one trustee, there can be more than one beneficiary, but I'm just stating it in its singular right here. So there's your planning that you're looking to do. Now, this is the point that you would look to say, well, how can I save costs? So let's turn to that now and look at the way that you can protect against the depletion of your estate. And the place where this usually comes up is that people get concerned about probate. And probate is a type of tax that applies when the will that a person has made out is submitted to the court for confirmation of its validity. So you make out your will, as long as you've done everything correctly and executed it properly, then it is the legal authority for your named executor to take care of the administration of the estate. The problem is that other people out there in the world who perhaps don't even know you all that well and don't know your executor all that well, they can't be certain that the will that is in that person's hands is not a forgery, or that there wasn't a later one that was made out. So what the executor does is submits that to the court and provides the appropriate documentation to the court to confirm that this is, to that person's knowledge and sworn statements, this is the last will of this deceased person. And then the court, once it's satisfied about that, will then issue back a certificate that confirms that the executor may act under that. And then the executor effectively has the full authority to then again gather in the assets and take care of all the tasks that are involved in dealing with an estate. So the charge that the court levies, or the Ontario government levies for that, is 1.5% of the value of the estate. So keep that in mind, 1.5%. It is a relatively small percentage, and quite often people will look at that and say, I'm going to avoid probate as much as possible. But in the course of avoiding this 1.5% tax, you can cause more problems for yourself than benefits you are providing either to yourself or the people around you. You could be triggering larger, or at least sooner, income taxes if you're not careful about it. You could put things into a position where you don't have full access to your own property if you give it away too soon. You could make things more complicated in terms of the transfer of your estate if you were to have that leading edge of avoiding this little 1.5% tax, and perhaps make a decision to dispose of your property in a way that, in the totality of circumstances, is not the best way to go about it. So again, keep the proportionality in mind. 1.5% is the probate tax. It's not charged on the first $50,000 of the value of your property, but it is 1.5% on everything above there. So having said that, there are some common ways that you can get around probate. The three most common ways is making use of beneficiary designations. So that would be on your registered plans, your RSP, your RIF, your pension. If you're able to name a beneficiary, then the contents of the plan will go to that person who is named beneficiary. And it will not then fall into your estate and then flow through your estate to that person. So no probate tax on those beneficiary designations, and also insurance designations. You can bypass the estate that way. The second type of way that you can get around probate is if you hold property in joint ownership. And this is commonly how you would see spouses quite often own their houses, their homes, maybe a cottage property, perhaps even a non-registered investment account might be in joint ownership, between the two of them. And the key feature of joint ownership is that when one of the joint owners dies, then the interest of the deceased person flows directly over to the survivor. Now, I said that in the singular to the survivor, but in fact, you can have more than 2 people. You can have an innumerable number of people as joint owners. It's common to do it between spouses. As you get out beyond spouses, though, it can get complicated. You can trigger taxes at times when you don't intend. You can expose property to creditors if you add on your children, for example, your adult children, and potentially then you expose to their creditors. You could lose control of property by doing that. You expose to matrimonial claims potentially in doing that. So a variety of reasons why you should be careful about adding non-spouses onto joint ownership. But with spouses, it's probably your first approach, and only where there is reason not to would you not make use of joint ownership. And the last item here is lifetime gifts. Giving away property during your lifetime means that you don't own it. You don't have any control over it at the point of your death, and therefore it doesn't fall into your estate at all, let alone for probate purposes. But having said that, be careful about doing that. As I said, I ran law practice where I would go see people in their homes, and quite often they were elderly people that I was seeing. And I had many conversations with elderly people who wanted to transfer their house into joint ownership with their own children, or give it away entirely to their children, driven by the idea of avoiding this little probate tax. And we'd have long conversations about whether it was appropriate to do that because of the dangers of exposing to the creditor issues, to the tax issues, all sorts of other concerns that, once all was taken into consideration, would lean towards allowing for probate tax to apply in many circumstances, because it fit the circumstances better to let that occur and maintain control over your own property. So with that, I'll just I'll close out with just a couple more points here about getting it going. One of the things that people often will do is say, yeah, I got to get my estate planning going, but then don't do that. So best of intentions, but the planning actually doesn't happen. So one of the things to do is to record yourself and your wishes. Again, you're giving the person who is your executor responsibility to take care of your property. And if you're talking about your attorneys, you're giving your attorney, your one or more attorneys, responsibility to take care of you and the things that you have while you're still around. So recording what you have and your wishes for that can be helpful to them. And one of the follow-up items that is going to be sent out by Libro is an estate planning information form that will assist with that. So that's something where you can put down information about yourself and the important property you have, the people around you, your advisors, and it'll be outdated in short time, but it does get the information down in one place at a point in time. Then you can come back and revisit it occasionally to make sure that it's reasonably up to date. Second item here is just generally communicating about the fact that you're doing your estate planning. You do not have to tell anyone what it is that you're doing specifically with your estate planning, and you don't even have to tell them that you're involved in the conversation or the thought process at all. But if you don't, then you won't have the benefit of their input. It could be that you think that between your son and your daughter is the one to take care of the executorship because your son has some serious problems with money management. And so you go ahead and you do that. You name your daughter as the person who's going to be the executor. And after you pass away, perhaps your daughter isn't comfortable with that and gives it a pass and said, no, I'm not going to do that, and steps away from it, does not accept the appointment. And then your son steps in, the person that you are concerned about their money management skills. He then perhaps is the one who is going to take on the mantle of being the executor. Had you at least raised it ahead of time, then you might have been able to come up with some other alternatives or have a conversation about the importance of this to you. So communicating with the people around you can be helpful, both in terms of those roles, but also in terms of the distribution of your estate. It could be that you intend to distribute it in a particular way, but maybe the people who are receiving that, they don't want to take on the cottage, for example, which is something that parents quite often will want to go down through the family lines. But in some cases, the kids don't want it. They'll be quite happy to sell it off, or vice versa. The parents are intended on selling, but one of those kids really wants it. So it opens up the opportunity to rejig what your plans are of how you're going to transfer your property by opening up the communications. And the last thing here is about review. When you're talking about doing wills, and well, all of the planning, but wills particularly, people will say, well, how often should I review my will? And there's no right or wrong answer about that, but I usually put it into three categories. One is that the passage of time, that's usually what people are asking for. How often would you do it? There's nothing magical about it, but I say 5 years time to come back and look at it, because as another round number, 10 years just seems way too far out there. But over the course of a 5-year time period, there's a couple of things that can happen. You'll have at least one and possibly two elections, both provincially and federally. So if you've got a new party that's come in, they may make changes to the laws that would then affect the plan that you put in place. It's not all that common, but it gives you an opportunity to come back to it because of those kinds of changes. The other thing is you have judges who are ruling on cases, and it may be that situations that are similar to yours are the part of a ruling in a case, and therefore it could be time to take a look at that and think it over. So at about a 5-year time interval, I'd say get back in touch with the lawyer and say, let's have a conversation, or should we have a conversation? Has something changed that should cause me to make changes to my will or to my other planning? So that's the passage of time. And then the two other things that that would cause you to make change, or at least review making changes, would be if there is a significant change to the property that you have that was in one form. Perhaps you had a cottage, which is now cash, and you made mention of the cottage perhaps in your will, or some other large item that existed that has changed. So if there's been a significant change to the property that you have, either in its form or its value, if you have anticipated that you're going to distribute a certain amount in certain ways, then if there's a change in the property in a significant way, maybe there is reason to make change to your will. And then the third item is the most important one. If there has been a significant change with the people around you, whether that's yourself or the other people around you. So has there been a marriage? Has there been a divorce, or even a separation? Has there been a birth that's happened, or a death of someone? Obviously your own death would cause your will to come into being, but of the people around you, have any of those things happen? Has someone gone bankrupt or had a serious health issue, which may be a problem for them to take on a particular role? Have they gone non-resident out of Canada or even out of Ontario, or have they come back? So significant life events for the people around you. So the three things, as I said, the passage of time, and I suggest 5 years, changes to your property, and changes to the people. And all of those things would be reason for you to call up the lawyer's office and say, this has happened. Does it give me reason to make changes? And of course, they'll invite you in to sit down and have a bit of a conversation about that, rather than just saying yes or no right at that point in time. So Paul, that's as much as I have to go through formally. I probably went a few minutes over than I intended in order to get the questions in, but I'm going to shoot it back to you and hold off while you go back over things for a second.
Thank you, Doug. It's a lot of great information. I did want to reemphasize for everyone watching, we are recording this call, so please, if you've missed the note, we will give you that opportunity to come back. So I've been watching the questions. I have a few specific ones I will follow up with you on, but generally I've grouped our pre-received questions into 4 categories: essentially tax, wills, retirement income, and capital gains. Not sure we're going to get through all of them, but we'll start with the probably the most popular one, was with respect to probate and minimizing taxes, how to avoid taxes. And you talked about some of that. Avoid is a good word. That's acceptable. Doug and I did have a brief conversation that evade is not appropriate, but you can certainly work to avoid taxes. And you talked about 3 common areas there: beneficiaries, joint accounts, and lifetime gifts. We are certainly at Libro made some changes about having good conversations with our owners about joint accounts, and when you are making somebody joint, to make sure that the intent is quite clear, because that intent will certainly help in future estate issues. So other questions around how to minimize, and one a couple times that came up, would Ontario ever consider eliminating the EAT or probate, as they've done in Manitoba and other jurisdictions. So just if you did have any other additional color there on probate and minimizing taxes stuff.
I would suspect, even though the so the probate tax in Ontario, the proper name is the estate administration tax, and they made a small adjustment to it recently, which was that the 1.5% now does not apply to the first $50,000 of the estate. So it was 0.5% on the first 50. Now they've just totally eliminated the 1.5% on that first 50. But I think that you'd be hopeful if you thought that the EAT was going to disappear altogether. I have no crystal ball about this, but I suspect that it'll just remain as it is, or it may become the subject of tax reform, because it is one place that politically there's always a lot of discussion about the broader scope of the tax system beyond the income tax system. The transfer of property from one generation to the next escapes a lot of the income taxes, and it could be that the government, particularly the Ontario government, so the provincial level, maybe decides to add on to it as opposed to reducing the estate administration tax. I'm not suggesting that's actually in the offing right now, but I just don't see it disappearing either. It just seems unlikely. It's not a big revenue generator for the government, but it's still there, and it's easier to make adjustments to something that exists than to reintroduce it at a later point in time. So I think we'll just have to accept that it's likely going to remain, and it's a nuisance, it's a cost, but it is there. So I'll leave it at that in terms of the probate tax. That's me just speculating anyway.
That's fair, Doug. Thank you. I know our estates team at Libro has had to deal with some significantly complex estates, and we do unfortunately on occasion, have owners that get dragged into, legal quandaries around that. So the best way to avoid or minimize tax is good planning in advance, as Doug talked about earlier. So some specific questions about wills, a real sort of basic one, but a good one, I thought. What age should you draft a will?
You can make out a will once you hit the age of majority. If you're in the military, you can make out a will earlier. And some people will say, well, wait until you've got property, wait until you've got a significant other. Otherwise, what's the point of doing it? My attitude on making out a will is that you do it as soon as you're legally capable of doing so. It is an unlikely event, obviously, that a young person will die. But if you put yourself in the shoes of the parents who have a young person, their child, who dies, what's called a death out of order, there's nothing more devastating to a parent than for having something of that nature happen, particularly with a young person. It's different if it's later on in life, but when you've got a very young person, it can be very devastating to the parents. So as a person who is capable of making out a will and making out powers of attorney, once you hit age of majority, I'd say go ahead and do that. You're doing it because you care about your parents and the people around you, not because you're trying to preserve assets in any particular way. It's to be responsible about the people who you care about and who care about you.
Great. A couple general questions, and then there are some specific ones from the audience today. How would Ontario treat wills from outside the province, from a probate or estate administration perspective?
Okay, so when a will is made, as long as the jurisdiction where it was made, when the person was resident there, as long as the rules for completing a will in that jurisdiction were complied with, then that will be a valid will. And then as you bring that will into Ontario, if you become an Ontario resident yourself, even though you perhaps made that will when you were in Saskatchewan, it continues to be a valid will as you come into become a resident in Ontario. So it will be granted probate. It will be accepted as a valid will. Another sort of turn on that would be a situation where you have, I'll take it the other direction, you've got your will here in Ontario and you own property down east in Nova Scotia. And in order to deal with the property down in Nova Scotia, assuming you only have one will, you are capable of making out a will in the other jurisdiction in Nova Scotia. But if you only have the one will here in Ontario, then the probated will here in Ontario can then be reproven or resealed over in Nova Scotia in order to deal with real estate that you would own in that jurisdiction. And for that matter, wherever the jurisdiction might be, I had a lot of clients who were from the Caribbean when I was running law practice, just kept on getting referrals from these people. And I said to them, next time you are back home, that was their original home, go and see a lawyer there so that you can make out wills and powers of attorney there specific to your property in that location. And I'll give you instructions on doing that so you don't revoke the one that we're doing right now when you make out that one. That one is for that property there. This one is for your general affairs because this is where you live right now. It's the core of it. And then that one's like the satellite that deals with the property in that jurisdiction.
Excellent. Thanks, Doug. Some questions about executors. I'll give you the sort of the grouping of them. Best practice for the number of executors. If I have more than one, does that add complexity to executing the will? And there were some related questions to that about the potential costs and benefits of using either a corporate trustee as your executor or your lawyer, a lawyer, to be an executor.
Okay, so the decision among the number of executors is, and again, not the proper term. The proper term is estate trustees. But the decision for the number of executors, to me, it's a consideration of efficiency versus oversight. So the most efficient committee is a committee of one. If there is very little controversial, if everyone gets along, and I'm not advising you here, of course, in this comment, but if everything is straightforward, then one person can get things done more quickly with less hurdles to go through, less documentation necessary than if you've got multiple people who might be involved. Now, it could be that they work well together and they divide up the responsibility, but one person will generally be more efficient in terms of getting things done than a group of people. And certainly where you're talking about spouse to spouse, commonly it's just your spouse who you name as the executor, not to have others that are also going to be joining in, unless you have complex property or if there's a concern about your spouse's ability to deal with the issues or the property because of lack of skill or just some other limitation. So the oversight aspect is, of course, if you have two or three, then you do have a check and balance kind of thing going on there, which is your decision whether you want to have others who will be able to keep an eye on things in a formal way. One thing to be aware of with that, and if you're using a lawyer, which I highly advocate using a lawyer, do not do it-yourself wills. It's a false economy for people generally, because there are so many things that could go wrong with the phrasing, and there are some things that really should not be in a will, and only a lawyer or somebody who's got the background skill will be able to work that out with you. So when you're making out a will and you have multiple executors, they can either be named as joint or as joint and several. And what that means is, as joint, they have to do absolutely everything together, hand in hand, signing off, absolutely everything. Under a joint and several appointment, each of them has full authority to deal with the estate as far as the outer world is concerned. And so you can divide up tasks and they can get done more effectively that way if you give the people each joint and several ability to deal with things. On the really big decisions, like selling a house, for example, no lawyer in his or her right mind on the other side of the transaction would accept one of the executors signing off on that, they'd require that that there be all of the executors who would sign off on something of that nature. But there's your distinction between joint, completely together, and joint and several, much more flexibility, but also the possibility that one could go rogue in some way. In terms of naming a corporate executor, in situations where there is complexity, maybe people don't get along. Certainly, estates are more complicated now. The administrative process is more complicated now from about a decade ago when Ontario made the rules a little bit more difficult to work within. There's good reason to look at a corporate executor to take on part of the role or entirely be named to carry out the role. The cost of having the executor or a corporate executor, you may hear about 5% of the value of the estate is what an executor might get paid. That's the high water mark. That's the highest that might be involved. There's more considerations involved in it, but in terms of a corporate executor, they definitely are not going to be charging any more than that, but that is their business to do that. And if you're looking for some kind of a professional organization to do that, then it's worth talking to a corporate trustee. They'll be happy to talk with you and not charge you for the initial conversation, and even for naming them. They get paid once they take care of the administration of the estate at such whatever the later date might be.
Okay. Yeah, there were also some questions in here. I'll go through a couple of them quickly. Can executor also be a beneficiary? The answer to that, yes. That happens all the time in family situations, especially. There was a question about, can wills with specific instructions still go into probate? Yes, depending on the reason why the probate is being requested. And financial institutions, frankly, can request probate because they can request probate. There doesn't have to be a lot of backup to that. Can a will include a list of people, charities? So this is getting into the specific intentions question. Can I provide a real specific listing of my assets, 20% to children, 5% to my favorite charity, etc., even if specific dollar amounts may not be known in advance? And can that list be updated, from time to time, perhaps in a separate codicil or document, without redoing the entire will?
So for big assets, it may be that you list big assets in a will, but it's not common to list off your whole inventory of property and what's going to happen with everything. What does happen quite often is that there would be a suggestion given, and I used to do this regularly, to the person that they prepare what's called a memorandum of wishes, where the person would say, here's how I would like my personal effects to be distributed. I'm not providing this as legal guidance to my executor, but it is for my executor to consider on how he or she carries out the responsibility, which is the legal formality that is in the will, that the authority is given to that person. If you include the items in your will, then you pretty much require that there be an update on a regular basis, which is quite often not necessarily costly to be doing on a regular basis. The use of codicils, I know that they're still capable of being done, but they're not as common as they were back centuries, well, decades or centuries ago, perhaps, simply because we've got word processors that you can replace a current will with a new will. The only time that I had done codicils were with wills that already existed from other lawyers, where I was brought in because someone was nearing death and the named executor had already predeceased. And so we were just replacing one small part of it, and to do the whole will over again did not make a lot of sense. But codicils are not as common as they may have been, again, quite a long time ago. So the listing of property is not, other than major items, is not commonly put into a will. It's more of a general direction, and then the person who's your executor will then carry that out as much as they can based on the instructions you provide in that memorandum.
Excellent. Thank you, Doug. And I know we're getting close to the end of our time today, so it's probably unlikely that we're going to get through all of the questions. There was a question about Are beneficiaries advised or shown the will to realize what they're going to get in advance? No, it's not a requirement. It's probably, to Doug's earlier points, the importance of communication, that importance of the people piece, and expressing your wishes, stating intent. All of those things are good, but you don't have to show your will to anyone in advance. There were a couple retirement income questions in advance and during the call here about asset allocation as you approach retirement and how to use retirement income, specifically some questions about using RSP income before retirement. My answer to that is it is an it depends question. It depends on your marginal tax rate now, in the future, other resources. That's one I would say we would have to have you speak with a coach, because there is no hard and fast answer to that question. And Doug, I guess there were also some questions around capital gains. There were a few questions about property. How is income, I think I've frozen up there, how income is taxed in the hands of the beneficiary. Is a personal residence inherited by children subject to tax? There were some questions about farm property, which are very specific as well. I didn't know if you wanted to, again, maybe just provide some general color on capital gains and just, again, it really comes down to the importance of planning, I believe, and getting the estate done properly.
Yeah. So on the matter of capital gains specifically, with an estate, one of the key things to understand is that when a person dies, their property is deemed to be disposed at that time, which means that though it is not actually disposed or sold, it's treated as if it had been sold. And if there are any unrealized capital gain, growth in value, then that gain is taxable in that person's final year, what's called their terminal year, January 1st to the day that the person dies. If you have a spouse, then you may be able to roll that property over to the spouse at your cost base and therefore defer off the point at which the capital gain will arise. But it is the capital gain is the tax liability of the deceased person. Anything that is distributed out of an estate is distributed to a person as an after-tax transfer. The estate pays the tax and then transfers the property that person is entitled to directly to them, and they don't pay any further tax on that transferred asset. And if it's a principal residence, then the principal residence exemption does protect against the capital gain being taxable to the deceased person. And if you then have named someone who's the beneficiary specifically of the principal residence, then that will be transferred by the executor out of the estate into that person's hands. And again, no tax will attach to that. It is possible that you can write out your will in such a way that you provide gifts to certain people and you require that they pay the tax on that in order to receive the gift. But absent that kind of an instruction, any distribution to a person out of an estate is going to be an after-tax amount that they receive. They don't pay tax on the receipt of it. There's not an inheritance tax.
Fantastic. Thank you, Doug. We've had a lot of great questions, some good conversations going on in the chat. There are some very specific questions in there about, relationship breakdowns, estranged, and one example of an estranged child being able to challenge the will and different things. So again, that really does speak to the importance of A, communication, stating intent, and B, that would be probably something that you would want to get good legal advice and update the will if there was some significant change you wanted to make. Anybody could come out of the woodwork after the fact and challenge your wishes, so making sure that they're stated properly is really, really important. I apologize that we're not going to get to all of the questions today. Karen, if you wouldn't mind bringing back up our slides again. We do have the opportunity in the chat. There is a link to a survey to let us know how we did. If you fill out that survey in the chat, and if you either A, indicate you would like to be contacted by one of our coaches to discuss your specific planning journey, or to follow up on a specific question perhaps we did not get to today, as a special incentive to thank those who joined us on our call, one of our respondees will receive $500 towards their estate planning journey to go speak to a legal representative of your choosing. It does come with some expense. Their time is valuable, so is their advice, and we want to make that journey a little easier for someone. So please keep an eye, either fill out that chat, and we'll also likely be providing that link in the follow-up emails as well. So just want to, again, thank everybody for joining us today. We really do appreciate your time and attention to this important conversation. I would like to remind all of our owners and future owners that all of our regions, all of our branches have access to accredited financial planning professionals and experienced coaches to help with these questions and conversations, including 29 responsible investment specialists. We have dedicated coaches to work with anyone. That's owners who are just getting started to business and farm owners with incredibly complex what's next financial planning. Very proud of the expertise, capabilities, tenure, and experience of our team. We are prepared to help you with these questions, a lot of them being better served at an individual level. You will be receiving some follow-up information from us on today's presentation, including some estate planning resources that Doug touched on earlier. Doug, before we sign off, just want to know if you had any last words of wisdom for our audience today.
I saw one of the questions there. You responded on my behalf about my lack of favor towards will kits, and I will reemphasize that point. It is a false economy. People will quote and say, "Oh, well, 99% of all wills would never have benefited from having a lawyer." And I like to see where they get these stats from. This is the merger of all of your life's activities into one fairly random point in time, where you are taking care of the people who are around you when you have a will and you die. So get the appropriate legal advice that you're entitled to when you have the opportunity to make out a will. So do use professionals for the services that you're looking for.
Thank you, Doug. Thank you, everyone, for making the time to join our call. The link for the survey is available in the chat. We will also make it available in the follow-up email we will be sending for those of you who provided us your email information in advance. And the call is being recorded and will be shared on our Libro website. Thank you, everybody. Hope you learned something today, and we look forward to talking with you. Our coaches look forward to talking with you in the near future. Thank you.